Today we're taking a look at Jefferies. Obviously slumping in the fourth quarter. The stock down about 1.6%. Maybe some green shoots there. Like if you want to see it, maybe it's there. Bloomberg Sonali Basak joins us now. Sonali, we care about this because it really helps set us up for bank earnings. What did we learn from Jefferies?
A few things. One is that deal slump has continued to weigh on performance. That shouldn't be too shocking because most of the announcements we've seen from the investment banking industry had come at the fourth quarter of last year. From the third quarter to the fourth quarter, total M&A deal volumes had jumped by $160 billion, but helped by some mega deals here, so overweighted to the likes of a Goldman Sachs. You don't see the fees from those until those deals close. So it's going to take a while for this investment banking comeback that everyone is talking about to be more profitable. There was the silver lining in Jefferies' earnings here, debt and equity underwriting coming back just a little bit here. That is also a good sign. There's this hope that with rates stabilizing, that this kind of activity, risk appetite is back a little more, even leveraged loans coming back in a significant way could help these banks. You are seeing Jefferies shares still down at almost 2%, about 1.7% on the day so far. And again, investors are basically saying to Jefferies, like the other banks, we'll see it when we believe it. We'll believe it when we see it.
Either one, it works.
We'll believe it when we, yeah. We're looking forward to Friday. We're trying to figure out what this means for the rest of Wall Street. What does it mean for the rest of Wall Street? Who are the obvious comparisons with what is happening at Jefferies that we can now extrapolate forward to?
If we're thinking about underwriting, JP Morgan, Bank of America, these are behemoth underwriters for debt deals. And if they are going to jump back, they will clip more fees from that business, of course, Guy. But even more than the investment banking business that has seen a lot of the pain last year, the consumer business is of very high interest here. On one hand, you could expect these banks to have a little less pressure from interest rates moving forward. You think about Bank of America and their mark-to-market losses, the hold-to-maturity losses, rather, and the change that they can hopefully see this year as the rate pain subsides. They'll talk a little about that. You also have JP Morgan, which of course has been very much been benefiting from an expansion in net interest income. Can they still see that expansion this year? We have consumers sitting on really record amounts of consumer debt. So what is the expectation from Bank of America and JP Morgan to extend new loans to consumers in particular? And what do the bad loans look like? That is a massive question in this part of the cycle.
Is it going to be just the CRE loans, or do you think or is it autos, is it home, consumer loans that really have to kind of focus on this go?
And the consumer loans, remember, you have to think about those for those big banks. You have JP Morgan, Bank of America, Wells Fargo, and Citi all on Friday. So it's a lot of information in the day.
Best day.
It's so exciting. And so after that, those consumer loans, the problems that you might see in regional bank and credit card portfolios are equally interesting this quarter around because they will give you such a big view into the consumer and the state of the economy. But for Friday's purposes, because these banks are so big, you think Bank of America, we talk about it all the time, the FICO score has drifted higher. So what are we then left with? With Citigroup and JP Morgan, you have to look at those credit card portfolios because we know that consumer credit in credit cards has surpassed $1 trillion across America for the first time last year. Something has got to come home to roost when you start to see the economy weaken. The labor market, again, still strong, but at what point do you start to see those record amounts of consumer credit card debt starting to sour? If there's any signs of that, there will be a little bit of fear in the market.
Charlie, what do we need to see with the banks reporting this season for Mike Mayo to be right?
Well, Citigroup, right? He loves Citigroup. And so Citigroup is one major individual story because they're in the middle, Guy, of a big turnaround. And we know that they've started to put inklings out there in terms of how deep the pain can go in terms of reorganization, potential job cuts, severance pay. They'll give more color around that turnaround story and then also potential drivers for competition. We were talking about investment banking a little earlier. Remember, the way that Citigroup's investment bank, the new structure works, is that it's rolled up into an interim head of banking that then has a number of people focus on different investment banking lines under him, commercial banking, consumer. So if those, what is the strategy? What is the strategy to bring new money in? For Citigroup, they've leaned a lot on those treasury and trade services businesses that have been kind of expanding beyond expectations for Jane Fraser. But what about those core businesses? How do they perform in the new era of Citigroup?